Stocks take a midweek dive, retailers report, and Cisco's guidance disappoints. This time on the Morningstar Weekly Wrap. After months of a sometimes eerily calm market, volatility returned with a vengeance on Wednesday with the biggest decline of the year over political worries. A decline like this is not a time to panic, but as Christine Benz points out in an article this week, it can be a good time for reflection. Is your asset allocation still reasonable? Does your financial plan really have the risk capacity to handle a short or medium-term decline in equity prices? Do you personally have the tolerance for it? And of course, always keep in mind that declines in prices also open up attractive entry points for investors, something that's been in short supply recently. Wal-Mart and Target both reported this week, and analyst John Brick gave us his take.
Wal-Mart and Target both reported earnings which were better than expected this quarter. However, over the coming years, we see diverging storylines and would recommend that investors look at Wal-Mart over Target. So to Target first, we think that they are undergoing necessary changes to capture e-commerce and digital sales. However, a higher proportion of their sales are higher margin, which, in this increasingly e-commerce and digital world, have more price transparency. Secondly, we don't think that they are done investing in their business, which will ultimately constrain margins and shareholder returns. Walmart, on the other hand, had a great quarter. We saw them beat numbers, but we also saw a 63% organic e-commerce sales growth, which was above our estimate of 30% and Target's 22% just a day ago. We also think that they are better positioned to withstand the competitive pressures coming into the U.S. as Aldi and Lidl enter the market over the coming years.
Cisco shares declined after reporting results this week. Analyst Ilya Kunzerov still doesn't see the shares as cheap.
Cisco reported third quarter 2017 earnings roughly in line with our expectations, but the company issued the downbeat top-line guidance with expecting 4 to 6% decline over the next quarter. The company's switching business along with the wireless and the security business were positive in the quarter, but we think that the company remains challenged in its core hardware business, primarily switching routing in data center. So we think the company is on the right path by building up the portfolio of software products, and we think that's the right strategy for the company, and we expect Cisco to continue on the same path over the next couple of years. With that said, we still see Cisco shares as a little bit overvalued compared to our $28 fair value estimate.
And in case you missed it on Morningstar.com this week, Ben Johnson looked at how investor returns differ for passive and active funds.